the investment landscape can't stay like this forever. You can't have equity returns that always go up 10% a year with very limited equity risk premium. And if that was the case, and investors do start to think, hey, how do I diversify? How do I strengthen or bolster my portfolio with some greater stability, lower volatility?
I'm joined today by Leland Clemons, founder and CEO of BondBloxx. Prior to this, he had a leading role at BlackRock in their ETF division. Leland, great to see you. Welcome to Monetary Matters.
Thanks, Jack. Good to be here.
My pleasure. I want to talk ETFs and something that I've always wondered about the ETF business, and I guess it points to investor behavior, investor psychology, is what do you see on inflows into bond ETFs when you're in a raging stock bull market like we are right now? And what does that say just about investor psychology and really human psychology in general?
Yeah, it's a great question, and one that we think about a lot here at BondBloxx. So the interesting thing over the last few years, obviously equity markets have been very strong, aside from a hiccup in April. And yet fixed income ETFs are garnering more than 30% of the new money coming into the ETF market. So I think what you've had, particularly since interest rates have rallied in 2022, 2023, you have investors appreciating that risk matters. It's not just prospective return, but what's the volatility, what's the risk of those investments? And now that you're actually getting something on bonds, there's real interest and coupon income in holding bond ETFs. I think investors appreciate the value of that income in a portfolio. Certainly this year, when we talk to investors, the volatility matters, right? And I think investors are starting to appreciate more and more that monthly coupon income inherently mitigates future volatility risk in a portfolio, right? If you are receiving coupon income every month, you're actually stabilizing that portfolio, which allows you to make potentially equity investments that have higher risk return profiles. So I think ETFs obviously continue to experience very strong growth, investor preference very strong, but fixed income ETFs are delivering outsized growth relative to their share of total assets and have been for the last 3-4 years.
So bonds are still growing. Bond ETFs AUM is still growing. So it's not like you're seeing people pulling money out of bond ETFs to put them into the stock market as the stock market goes up. That's what you're not seeing. That is what you're saying.
No, I think you're seeing some investors allocate more money because obviously they are acquiring new clients. There's new money coming into the ecosystem of the investing landscape. I think more of that is going to fixed income, or we see more of that going to fixed income than has been in the past. So it looks more like kind of a 70-30 allocation, as opposed to prior to 2022, you would have seen that look more like 80-20, sometimes 90-10. Right. So I think the return of a real interest rate and the return of coupon income has brought investors back to fixed income. So I would say investors are giving fixed income some love that they hadn't given for a while.
Okay, interesting. When would you say was the period where fixed income was unloved? Because there was a period where it was,
Yep.
with the benefit of hindsight, quite unattractive when the 10-year was at or below even 1%,
Yep.
where you did not have that protection you're talking about in the coupon at all. And obviously, they experienced quite dramatic losses for bonds
Yep.
in 2022 as interest rates rose, the 10-year rose. So just, what was the investor psychology like? And when did they go from being loved to unloved to now being loved again, once again?
So I think the period where fixed income was sort of in the corner of the investment classroom would have been in sort of 2008, 2009, all the way through 2021, right? So you're getting very limited to negative real rates on fixed income returns. The equity market seemed to do nothing but go up. And so I think investors were very conditioned to, hey, I'll do anything but fixed income, which candidly was central to the thesis of starting BondBloxx as a company. We had a view in 2021 as we were looking at the landscape of what we could do to innovate and evolve the ETF industry. We had a view that the investment landscape can't stay like this forever. You can't have equity returns that always go up 10% a year with very limited equity risk premium. And if that was the case, and investors do start to think, hey, how do I diversify? How do I strengthen or bolster my portfolio with some greater stability, lower volatility? The fixed income ETF product landscape was woefully underdeveloped because as an asset management industry, we're pretty good at giving investors what they ask for, right? And nobody had been asking for bond ETFs for 15 years. And so there hadn't been many built. So that was actually very central to our thesis of like, hey, we got to come out of this period where bonds and coupon income are not valued for what they should be, which is why we started BondBloxx in 2021. And I think since 2022, when the Fed started raising rates, obviously it's a difficult time to get through as a bond investor, right? Rates going up, prices coming down. But I think from late 22, 23, I think bond ETFs and the bond market in general has started to feel some of that love from investors again. And we expect that's going to continue.
What do you think makes for a good ETF versus a bad ETF? And yeah, talk about your career at BlackRock, because I think probably even 5, 10 years ago, but especially now, you see a lot of ETFs that kind of they beg the question, like, why does this need to exist? What need is this actually serving?
So just funny anecdote. I remember in 2006, I was at iShares, which was then part of Barclays Global Investors, predecessor to BlackRock before BlackRock bought BGI. And ETFs in their sort of golden age of being built out were sort of 6 years old, right? And I was having a conversation with someone else in the product team, and we were sort of looking around like, I don't know what else there is to do. Like, we've kind of done everything. Like, what else could you put in an ETF? We've done equities, we've done the core fixed income benchmarks, and we've done international. So I guess the learning since the last 19 years is, I think we can continue to, and there's always way of innovating product to satisfy some segment of the investor marketplace. So there are products out there right now that would call themselves an ETF, and they do 3 times leverage or inverse of single stocks. I'm not sure that is what we thought of as an industry when we said let's build ETFs back in 2000, right? But it is satisfying some need for certain investors. I don't think it makes up large portfolios of fee-based advisors. So I think there will continue to be room for innovation. At BondBloxx, we focus on, hey, what are ways for us to deconstruct fixed income benchmarks in a way that allows investors to more precisely allocate risk, because there are risk dimensions embedded in a broad exposure that actually are too blunt, right? So I mentioned high yield, but we also have triple B investment products, so triple B investment grade, where we did triple B short duration, triple B intermediate, and triple B long. And the reason is there had been no triple B corporate bond ETFs, which sounds pretty granular, but in fact, there's a very compelling argument that triple Bs deliver outsized return with almost negligible increased default risk over longer periods of time. So having investors having never had access to that exposure, that for us is something that's innovation. At BondBloxx, we can do something different. But I think there'll be lots of innovation in the ETF landscape. You asked what's good and bad. I won't be the arbiter of good and bad wholly. I'll offer our perspective at BondBloxx, which is I think an ETF should continue to hold true to transparency. Right? You should be able to do what you say you're going to do, and you should be able to articulate that investment philosophy or strategy in a very straightforward way to investors. If you can't, then I think you sort of put the ETF industry at risk a little bit. I think the exchange traded piece is really important. ET inherently, right? Like, there should be multiple market makers and market participants to provide liquidity to investors in the way they would expect on an exchange. We think that's really important. And then the last I'll say, I think the ETF industry, I'll say what I don't think is necessary in an ETF, although it's become sort of common expectation. There's this view that ETFs are really, really cheap. right? And I don't think that is necessary. At BondBloxx, our products tend to be on the lower end of the price curve, but I don't think being cheap is a necessary thing for ETFs. We hear a lot about price wars and things like that, but actually, what ETFs have done, and I think this will continue to be true, is generally deliver better value to clients at different exposures than other product wrappers. I think that will continue to be true. Um, so I don't know. That's sort of like three thoughts on what makes good and bad. I'm a real big stickler for, and we are as an organization, of like the transparency. And if you say you're going to do something in an investment product, don't be cute and try and sort of say something and then kind of do it. Like, do the thing.
Talking about fees, there has been a fee war in exchange traded funds, particularly in the very vanilla products like
Mhm.
S&P 500 and the
Right.
like. I wonder how much of that has been fostered by the move from brokerage, the commission model, to the fee-based advisory model. But in particular, why do you say that you don't think that the fees have to be ultra low, and why do you think that they're, in the same way that the fees are on S&P 500 ETFs just go down and down and down, the same
Yep.
won't happen for your ETFs?
So S&P 500 exposure has always been fairly low on the pricing scale, right? So I don't think ETFs, just putting in an ETF and all of a sudden that product being inexpensive, I don't think that's necessarily an ETF thing, right? You go back 30 years, S&P 500 institutional index funds were in single digit, if not low double digit basis points. Maybe the ETF innovation was democratizing access to that lower fee that institutions were paying to a broader set of investors who might have been paying 50 basis points, and then it went down to 35, and then it kept coming down, as you articulate in the sort of ETF fee war. But there's also been the same fee compression's been happening in the mutual fund space and the institutional space. I think there's just as investment management innovates, as the ecosystem for running investments has become, I won't say more commoditized, but more efficient, those savings are being passed on to investors as they should be. So I think S&P to S&P, like institutional fund to ETF, I think that's democratizing access to lower fee. I don't think necessarily there was like the price war did that or anything like that. What I will say is I think the ETF industry will continue to deliver those economies of scale that may exist in other wrappers like institutional funds down to ETF investors and the more retail audience that may have been paying more for that same exposure for a long time. So I'll give you an example. Like we launched our first private credit ETF about 7 months ago. It was the first private credit ETF in the industry, and that product is 68 basis points. If you compared that to an S&P 500 fund at 5 basis points, it might look relatively expensive, but actually relative to any other private credit or investment, probably half the fees. So I guess that's more what I meant. Why I don't think everything is going to 5 basis points. I think the ETF market and our opportunity as an industry is how can we pass down some of these economies of scale that have existed in our industry or are evolving in our industry to a broader swath of investors. So it's not just the biggest investors getting to pay the lower fee, but rather a broad set of investors benefiting from the industry's innovation.
Tell me about that private credit ETF. What motivated you to create it?
So, really simple, actually. We started BondBloxx with a simple premise: like, let's go out and talk with investors and understand, in this thesis of fixed income being underdeveloped in the ETF landscape, what could we build that would be valuable to fee-based advisor portfolio construction. And one of the first things we heard was private credit. Not the easiest to build, so it's not the first we launched, but it was one of the first things we heard over and over again. Hey, could you put private credit in an ETF? So that was the real motivation, and we are fortunate fortunate to have a team here that is long on experience and passion to innovate. So whether that's coming from, as you say, BlackRock and iShares, or Goldman Sachs, or JP Morgan, or Vanguard. We're long on fixed income and ETF chops. And so a challenge also seemed fun. We could launch treasuries and investment grade and high yield. But figuring out private credit was a little trickier. So yeah, we spent a couple of years trying to figure out what can we do in the private credit space, and where we landed that I think satisfies the attributes that I described earlier: transparency, being able to do what the product says on the tin. Is we looked at this segment of private credit, because private credit is huge, right? It means lots of different things: real estate, infrastructure. We built a fund that invests in middle market loans, often referred to as private credit CLOs. So we've got a portfolio of CLOs that hold middle market loans. They are underwritten and issued by the largest private credit managers in the world, right? Ares, Blackstone, Golub, et cetera. It's a diversified portfolio of private credit CLOs. I think we own 62 at the moment. Those CLOs individually each have a portfolio of loans within them to different middle market companies. So we've delivered diversification in an ETF wrapper by holding instruments that actually trade. So unlike having to go without having to go to the individual issuers, CLOs actually trade, right? There are other ETFs that have owned CLOs. They just haven't gone down to the private credit tranche yet. And so I think we've satisfied, the core attributes that we feel hold the integrity of an ETF, while also getting private credit into that wrapper. So really, I'm really proud of the product. It's delivering just over 8.5% yield. As I mentioned, 68 basis points. It's quite a bit cheaper than most interval funds or other private credit access wrappers, and you can buy it on an exchange without having to go through what can be operational complexity of just being able to invest in private credit.
So let me break down a few things for the audience, and correct me if I'm anything wrong. So yes, I think they're in 2021. I think there were some CLO ETFs, collateralized loan ETFs, but they were of the AAA highest tranches. And I actually did I did not understand the product at the time. I did a piece for the company at the time, Real Vision, about how these things seemed kind of dangerous, but really they were AAA, and those I don't think ever had taken any impairment ever. But and then my actual current sponsor, Van Eck, did something that with the CLO ETF, and they did more of the middle tranches, but some upper as well. But all of the loans, when you own a CLO, you're owning the liabilities of the CEO of the CLO. The assets are the loans from those companies. So you're owning the certain tranches. But I think what you do that's new is the loans in the CLOs are private credit companies. They're not from the BSL, broadly syndicated loan market, which is Burger King, Yahoo, and then we put those loans in. These are like companies that most people I have not heard of. So they're smaller in scale, as you say, middle market. What is the liquidity profile of those loans, of those middle market or private credit CLO tranches and the CLOs? Because look, even with things that are liquid, even with like municipal bond market or the treasury market, even and when there's a liquidity crisis, even like in March 2020, you have some discrepancies from net asset value in the ETFs.
Sure.
But I imagine in these products that risk would be higher, because if there's a liquidity crisis, like there was actually almost exactly a year ago, when people talked about the yen carry trade and the VIX went to 60 for like a few minutes before the market opened, like what happens to the market for private credit CLOs? What happens to the ETF fund that owns those private credit CLOs, where that can be traded, unlike those other things? So there's kind of an asset liability mismatch in terms of liquidity.
So to answer your question, I think first I just want to point out, because I didn't appreciate it when we were building this product, but there are over 300,000 middle market companies, sort of as described in the context of our fund and the loan market. They generate over 13 trillion in annual revenue. So it's a really meaningful part of the US economy. And I think as investors, sometimes I hear things like middle market loan. You think, oh, small, right? It just means they didn't access the broadly syndicated market. And in fact, the private credit market has grown to be such a valuable source of funding for companies over the last 10 years that I think it's important for us to, as an investor group, to appreciate, like, doesn't mean like small or necessarily overly risky relative to BSLs. There are plenty of broadly syndicated loan companies that have same credit quality as middle market loans. These are just companies that have chosen to access capital a different way. To your point about liquidity, there's no question there are degrees of liquidity across the fixed income spectrum, right? There's the short treasury market and all the way through the treasury market. Then you can get to investment grade and US high yield and down to, as you said, munis. And there is and has always been a sort of I'll call it a lower level of intraday liquidity in specific bonds as you move down that spectrum. Doesn't mean there's no liquidity, just means there's less. Spreads may be wider, volatility may be a little bit higher. And I think that is true today in the private credit CLO market, right? I would expect like the most liquid and largest issuances of high quality CLOs to be more liquid than private credit CLOs. That said, liquidity across CLOs has been evolving pretty quickly in a positive way. Many more trading desks getting involved in the CLO market. I think the ETFization of CLOs has helped with that, just as it helped with the municipal bond market and the high yield market. And so we actually haven't seen any issues. The fund is just shy of 150 million in its first seven and a half months, and we've had plenty of volatility. I think April was no walk in the park for generally the liquidity markets across asset classes, and our ETF and the private credit CLO market held up really well. But you're not wrong at all to say this is a market that is earlier in its development than other parts of the credit market. And I think I'm excited to see how the ETFization of private credit CLOs supports and in tandem works to evolve the liquidity of the private credit CLO market.
Yeah, I noticed that as well, that in the volatility of April, the stock market is tremendous, but I did notice, yeah, the private credit ETF did hold in there, like the high yield market and other markets, much better than the equity market. So I know, and I was surprised to learn that you had the fund, because I know there is another fund with another
Uh-huh.
ETF company and another liquidity provider. What is the difference between your two funds? Because I know the other fund, it's a little complicated. Are they actually owning like private credit loans instead of the CLOs?
I guess I'll focus on what our fund does, and I think I'll just say, and it's different then,
Mhm.
as opposed to try and articulate what can be complicated in other structures. Candidly, I wouldn't want to misspeak. So, as I mentioned, like our product owns over 80%, I think close to 85% middle market loan private credit CLOs. So it is a private credit ETF. You are buying CLOs that own direct loans from major private credit issuers. That we own a small amount of broadly syndicated loans. But that tends to be, to your point, if for some reason like there's an attractive yield in the BSL market that day in a double B CLO, we'll go and buy that for a placeholder. I think that's less true in some other ETFs where they might say private credit, or they might be suggesting private credit, but the majority of the product is actually an investment grade corporate bonds. And then it's almost inverse. Some small portion is in private credit loans directly issued from one particular underwriter. The challenge that we saw in a structure like that is, again, goes back to liquidity provision. I want multiple market makers to be able to make a market in our fund, which means they should be able to buy and sell the underlying securities that we are looking to own in the fund. When a product is buying a particular asset from one liquidity provider, the liquidity of the fund inherently is concentrated in the performance of said liquidity provider. So it goes back to, again, like core tenants. Like that doesn't work for our design of an ETF. It doesn't mean it won't work. It's just a big difference. And so whereas our private credit fund has a diverse portfolio of credits from different issuers, my understanding is other products may have private credit exposure from one issuer / underwriter of private credit.
Mm.
I think that's the big difference, candidly.
That makes sense. Thank you. One thing I'm curious about is I have a rough understanding of how ETFs are created. If I or a customer buys an ETF, just to say of the S&P 500,
Mhm.
It's the authorized participant who then buys all of the shares in the S&P 500 and then delivers that. So it's the authorized participant or market maker who kind of makes that. What is different about that in bonds versus stocks? Because you can buy one share of Apple for like $220,
Mhm.
but I don't think you can really buy. Let alone treasury bonds. But if you, I think you have a healthcare only high yield fund or all
Mhm.
these stuff. It's incredibly diversified, and a lot of these things, you have to buy what, $1 to $10 to $20 million at a time. I don't know, but how do you kind of generate that exposure? And is there kind of some some balancing out where, okay, we'll actually overweight this and overweight this, and they're very similar, or how does that work out?
I guess at the core of it, I would say fixed income ETF, the majority of fixed income ETFs work exactly the same as equity ETFs in that, as you say, a market maker or in ETF land, we've come up with these terms, authorized participant, but think market maker, liquidity provider, is just buying and selling on an exchange, right? Making a market as they do in other stocks. And if they need to replenish inventory, right, to create more shares, they'll go and they'll come to an issuer like BondBloxx and essentially ask us, like, what's the recipe of securities that I need to give you in order to get shares of the ETFs so I can sell them on to investors on an exchange. And that generally means we've got a list of which bonds we want and how much of each one we want. Same as an equity ETF, right? And so because bonds can in fact be delivered, we call it in kind. So instead of giving us cash and we give you ETF and then we go and buy the bonds, you give us the bonds and we give you the ETF shares. In kind exchange. That also works the same for fixed income as it does for equities. What you're alluding to, I think, is you can't always find every single bond in the exact same recipe weights that on every day that we want. The S&P 500, no problem. In high yield, short high yield, like maybe you can't. So what most issuers do, and BondBloxx is similar, and I think we're quite good at this, is you look for common characteristics. So I may want bond A, and I want $500,000 of it to make up the total contribution towards the portfolio. But I can't find bond A today. But actually, bond B looks very similar in maturity, duration, yield, industry sector, credit quality. And so we will substitute and take bond B. And that's where you get into the expertise of the manager in there's both science, and now I'm describing as some art to the portfolio of how do you deliver the returns and manage a portfolio tied to, particularly if it's an index that investors are expecting. And so we say at BondBloxx a lot of time, there's a lot of art that goes into being an index. There are lots of active decisions made every day in managing a passive fixed income fund. And thankfully, we have a team of portfolio managers that have been doing this for a really, really long time. Where we benefit from a team that launched the first fixed income ETFs back at iShares in the early 2000s. Same was true. One of our portfolio managers launched Vanguard's fixed income ETF portfolios, and another launched State Street's fixed income ETF business. So we have a lot of experience doing this, but you're right. There is some art that goes along with the science.
And what percentage of your funds would you characterize as passive instead of active, and what percentage of them are tracking an index?
The majority of our funds are passive. We have a handful of active funds, some of which we manage ourselves, some of which we manage in partnership with a sub-advisor. So our private credit fund is managed in partnership with Macquarie Asset Management. They obviously have a very robust private investments business, and they've been a really great partner in initially, candidly, helping us to learn the private credit market, and then subsequently helping us and working together to how do we innovate and how do we structure this product and how do we evolve it and what can we do next. On our other sub-advisor partner is a firm called Income Research and Management. And with them, we have launched a suite of tax-aware strategies. Tax-aware being the fund owns always at least 50% municipal bonds, but may own up to another 50% of taxable bonds, where the objective is to maximize after-tax returns as opposed to minimize taxes. And it sounds like a subtle distinction, but it's a pretty central one, right? I think for a long time, our industry has talked about the virtues of munis and that you'll never pay taxes, right? If you get double tax. But actually, shouldn't the goal be to maximize after-tax returns? So like if I said, hey, I'll give you $20 and you don't have to pay taxes on it. And I live in California. So, or I said, Leland, I'll give you $100, but you got to pay $53. Like 47 is more than 20. I'll take the taxable, please, all day. But for some reason, like that concept, at least from the investment management landscape, which we're calling tax aware, just hasn't been evolved as much. And we've sort of put forward, buy munis. And I think with income research and management, our view is like, it's not just what you earn, but it's how much you keep. We can do better.
And when you have these niche products you're developing, such as a sector-specific high-yield ETF, is that, are the indices just the high-yield ETF, and then you'll have the tracking area that is like what clients want is the tracking area because they want that specific exposure? And then how do clients kind of judge success for that?
So it's a good point. So first of all, I think oftentimes it actually is the investment manager working to come up with an idea, presenting an idea to an index partner or a market data partner or data firm. And then there's some also co-innovation or co-development of how do you create said index. I think in construction of a new index, so for example, our high yield ratings products, right, are deconstructed from a parent index that already has ETFs benchmarked to it that are quite large, quite liquid. So for us, it made sense if we're going to deconstruct something to allow more flexibility and precision in portfolio construction. Let's make the thing we're deconstructing something. Let's do it from something people already own. So that when we go and have this conversation of like, hey, this is how much you own of double B, single B, triple C's in your broad high yield index. What's your investment thesis? Are you concerned a little bit, cautious about high yield? In which case, wouldn't you overweight double B's? Or if you're actually quite bullish on the economy and not concerned about defaults, like why wouldn't you reach for extra yield? So that was sort of the logic. And I think that is sound logic applied by most issuers of like, if we're going to deconstruct and go more granular or innovate, like, can we do it from a widely adopted existing ETF? Then when you're building a product, like, and you're innovating, I think it's important, as we discussed earlier, build something that you can actually perform against. So sometimes you have to put some constraints on a broader index or the index that you're targeting because it's not investable. So you might see the word investable index on a lot of products, and that just means there have been some changes made to the pure cut index because it's not investable, or the investment manager felt like, I can't deliver that. So let's do something slightly different. We put, as an example, on some of our products like a cap, like a 2% cap on the max any particular holding would be in an index, because we have said, hey, we value diversification, and we think investors do too. If we didn't put a cap, you might have one security that was 9% of an index, and that might not be delivering the diversification that clients actually expect or want from an index fund. So I think that's where that co-development sort of evolution of an index happens, hopefully towards being able to deliver what you say you're going to do.
You said we don't have a single security, over 2%. You don't want a single security as 9% of an index. I think of just this morning, I looked at the S&P 500. Nvidia is 8%
Yeah.
of the S&P 500. How do you think about the concentration risk within the S&P 500? I'll seed the ground here and say for 20 years, people have been talking about there's concentration risk in the S&P 500. And of course,
Yeah.
the biggest and best companies have just gotten bigger and bigger, and they've continued to deliver value. But how do you think about just the scenario where actually like there could be a huge bubble, and maybe these huge companies are really overvalued, and that could to the entire world who's super long the S&P have a very adverse outcome?
Yeah, I guess first and foremost, I would say one of the nice things about the particular instance you're describing with NVIDIA or any of the Mag 7, Mag 6, we keep adding something to a Mag, is that it's not a secret, right? Like, it's transparent. You are, as an investor, very, very easily able to go and see, what am I buying, right? As opposed to, I think, what can be challenging is if you're investing in a product and it's not transparent, it's not clearly disclosed, and you don't know that you have that concentration risk. And so as an investment advisor, you own this fund, but I didn't know it owned 10% of one stock. So I do think that is a benefit of a product that's transparent. That said, I also think you're hitting on something that's important, like that how do we as investors and as an investment management industry, like, navigate this concentration of money flows, when we know how broadly embedded S&P 500 funds in particular are across retail and investment advisory portfolios. Just the purchase bias that is embedded into the market, particularly if those funds are reinvesting dividends and so on and so forth. There's just strong purchase bias to some of those companies at the moment. I don't know how that plays out over time, other than I do think that it's a healthy exercise to go back and look over the last 50, 100 years. How many of the names that weren't even in the S&P 500 are still in the S&P 500? How many of those that were in the top 10 were there for more than 20 years? I think sort of animal spirits of the corporate landscape somewhat sort that out over time. But I do think as an investment industry, like, that's something for us to be aware of, is what happens when so much of our fund flow money is actually just going into a highly concentrated group of stocks.
And a lot of managers in the equity space have found it hard to beat the S&P 500. I think that active managers have had some more considerable success in beating the passive bond indices. And the reason I've heard, I think, in the literature on this, is that they do their credit underwriting, and they just buy the higher yielding thing that they think is likely going to pay them back, and then they beat the index. So I've interviewed active credit managers who say this is the importance of active management. We charge a fee, yes, more expensive fee, but that we can beat the index, and that's the value of active management. So when you're talking to clients who have heard that and that thought is in their ear, what is your response to that?
I think the science, and we've been doing some research that hopefully we'll put out next year. I think the academic or the science on this will show that, just as in equities, a lot of fixed income active performance is asset allocation, right? And we've let the long accepted principle on the equity and broader portfolio construction front. Somehow we sort of decide that, but maybe that's not true in fixed income. Fixed income is different. I think as an industry, we probably have done a disservice long term in making fixed income sound really complicated, right? It's got its own terminology, duration, and convexity, and things like that, or almost put up a wall around the accessibility of fixed income and make it different than equities. But I think when you look at performance over time, you are right that for that period that I referenced where sort of fixed income wasn't attractive to most people, most investors, most core bond managers became core plus managers, meaning they bought high yield, 10% of the portfolio in high yield. And by virtue of the fact that the ag was yielding so little, you're inherently outperforming. Take a little risk in a market where you've got a Fed backstop for corporations. Investor managers feeling pretty confident about that. So, of course, looks like you outperformed for a period of time. But what you did was actually not outperform apples to apples. You took excess risk. That's different, right? Much in the same way, if as an equity portfolio manager, you say, yeah, I can beat the S&P 500, not by misweighting the stocks, but I'll buy Russell 2000 for 10% of the portfolio. That's different. That's not apples to apples. That's you add some new ingredient that adds risk, which enables you to outperform in certain environments. In fact, when you look for the last couple of years, even just within the high yield space, we've done some work looking at high yield active managers. Most high yield managers had a hard time beating the broad high yield benchmark for 2023 and 2024 in particular. The reason is most high yield managers are structurally underweight CCC bonds, right? It's a harder element of the market to navigate. It requires research teams, and a lot of high yield research teams don't spend time in CCC land. CCCs actually were the number one performing asset class in corporate bonds for 23 and 24. So if you were underweight CCCs, you underperformed the broad index, which owns 12% CCCs. So I think, again, my view is a lot of this comes down to asset allocation rather than picking the right individual bond here and there. Because if you get the big stuff wrong, it's hard to get enough of the little stuff right. I think that principle is as true in fixed income as it is in equities. And again, we're working on some research that I think will bear that out.
And in this world where, let's say, the high yield, I'm just making numbers up, but like it yields 6% and
Mhm.
3% is the risk free, and then the 3% is the option adjusted spread, something like that. Half of the yield that investors get is all basically from the free
Carry.
from the risk free rate. Very different from, in a world where the risk free rate is 1% and the credit spread is 6%. So you make sense to pay because 6/7 of your yield is active management. Do you think this environment where your investors are getting a lot more quote unquote for free because of the Fed and higher rates is more conducive to a passive world?
I think, as you said earlier in the conversation, you asked the question like, are fixed income ETFs now getting some love from investors? And I think a lot of that love is from what we call the carry or the risk-free rate, right? Being back to some normal level. We feel like that normal range is probably going to persist with somewhere in the 3 to 4% for a period of time. And I think that will continue to drive flows. I think investors appreciate that income and that portion of return embedded in the coupon they're receiving, because it's also embedded, by the way, right, in the equity market, just in a different way, right? The equity risk premium is in some ways, right, like the equity reflection of risk-free rate in the bond space. And the equity risk premiums are pretty darn low, right? I mean, we talk about, and the stock market's up, 25% since April. But if you look at forward PEs, they're at extraordinarily high levels relative to any historical average. I hear a lot of clients talk about we're waiting for spreads to widen out in fixed income. But for spreads to widen out, there's got to be a good reason. And that reason will also become evident in the equity space, likely first because equities are lower on the cap structure than fixed income. So if there's any cracks in the market, we'll see it in the stock market first. But we just saw an earnings season that looked really strong. Corporate balance sheets look really strong. I think investors are feeling good about bonds in particular right now. And so I think they'll continue to find the carry plus the coupon, the carry plus the spread attractive.
Right. So this is a macro show. So I am going to attempt to ask you about your macro views. So first, I want to give the disclaimer that your macro views are not influencing the BondBloxx like products themselves. And
Mm.
if say for example, if you were bearish on duration and thought the 10-year would go up in 2021, that doesn't mean that BondBloxx like isn't providing the duration exposure, of course.
Yep.
So with that being said, what is your view across the yield curve? If I ask you about the overnight rate, the 2-year rate, and then the longer end of the curve.
First and foremost, we have more confidence in looking at and feeling good about credit today, corporate credit, than we do duration. And by that, I mean I think there's going to be more volatility, particularly in the longer end of the curve, than there is volatility due to any fractures in corporate credit. I said just a second ago, we think balance sheets look really strong. Default rates are actually at like historically very, very low numbers. And so we like credit over duration. We have for a while. We think that persists. Part of the reason is we think the market's been betting on a Fed activity that it wants to happen rather than what the Fed needs to do within its dual mandate. And that those have been bad bets for a lot of people, right? Betting on, Fed's going to cut. No, the Fed's not going to cut. There's no reason to cut. In fact, aside from some of the recent non-farm payroll data, most of the data continues to reinforce like the Fed should keep rates right where they are. I think common perspective right now is that we might get a couple cuts before the end of the year, but we'll see. And that's been a very fluid expectation over the last couple of years.
Yeah, I was just thinking that if you have the view that you like credit a lot more than duration, these products you give access to them, others as well, of course. Of investors now can get access to floating rate loans,
Mm-hmm.
which I don't believe was the case 10 years ago, right?
Certainly in ETF form. I don't know when the first floating rate product is, but I'm guessing I think you're right, somewhere in the last decade. Which again I think is a benefit of an ETF industry that has evolved considerably. Now, as investors are faced with different market environments than we were 10 years ago, 5 years ago, you have more choice. What comes with that is the responsibility of doing the work. But the RIAs that we work with are not short on digging in and doing the work. And I think they appreciate having more product choice. That I hear oftentimes like, oh, there are too many ETF products. And like, if nobody was buying them, there wouldn't be, right? So utility is inherently represented in the ETF space by assets and trading volume. And as long as those two things exist in a product in some way, which I think is the case in the majority of fixed income ETFs, certainly from BondBloxx, but across the industry, we'll keep innovating and we'll keep offering choice so that as the people are navigating their macro views as well as their more fundamental fixed income views, they can reflect those in a portfolio with greater precision.
Mm. Final question is about the high yield market. A lot of people who, when they think there's going to be a recession, they have a bearish view on the high yield market, and of course, the high yield spreads would widen in a recession. But do you think that enough people understand the transformation in the capital markets, where actually the junk bond, the risk in the junk bonds of the 1980s and 1990s is not a lot of it has moved outside of the high yield market, and the high yield bond market has actually shrunk, and a lot of the more frenzied deal making activity is in the loan market and the private credit market. And so do you think that maybe there's a new average high yield spread, and it's not the old high yield spread because a lot of that risk has migrated?
So we've had multiple conversations about this inside BondBloxx and with clients, particularly on the institutional side. I think you're right. I think the new high yield spreads, there is evidence that they are structured. The structural normal is smaller, right? Like, what if high yield spreads used to be 600 on average? Like that might be now 500. And there are a couple of reasons for that. One, you have broader access to high yield than was the case, right? So more investors making more decisions oftentimes means that illiquidity premium goes away. Certainly, you've got some of the largest high yield ETFs actually trade as much, if not more, than the high yield bonds themselves. But that means high yield is more broadly accessible than it has ever been before. That in of itself collapses this illiquidity premium a little bit. Then I think you've got the evolutions of market structure. So trading of high yield bonds, as an example, on platforms like TradeWeb or Market Access or Bloomberg, much more active than it was 10, 20 years ago. And when there's more trading, inherently also you're going to get that illiquidity premium collapsing. So there are two reasons that I would agree with you. I think today's fixed income and corporate credit market is different. And that I would go back to largely that illiquidity premium has just shrunk, in part due to the ETFization of an asset class. And so I think that's another benefit of fixed income, of ETFs in the fixed income space, is that broader access is inherently going to shrink the illiquidity premium, but it means investors have to recalibrate a little bit, right? So if you're expecting, hey, I'll buy high yield when spreads blow out to 1,000, which I have heard in the last 3 years, you might never find that. Right, that's going to be a very extreme event, as opposed to it might have been what things looked like in a wobble 10, 15 years ago.
We'll leave it there. Leland, thank you so much for joining us. Reminder to everyone listening to check out Monetary Matters on YouTube at the Monetary Matters YouTube channel, and also leave a rating and review on Apple Podcast or Spotify. Thank you.
Thanks, Jack.
Thank you. Just close the door.